In the 1600s, the Dutch East India Company sent hundreds of ships around the world to trade gold, porcelain, spices, and silks. But it wasn't cheap to run this large operation. To pay for their expensive trips, the company turned to private citizens, who could invest money to support the trip in exchange for a share of the ship's profits. By doing this, the company was able to afford even grander trips, which increased profits for both the company and its smart investors. By selling these shares in coffee shops and shipping ports across the continent, the Dutch East India Company accidentally created the first stock market. Since then, companies have been getting money from investors to support all kinds of businesses. And now, there are schools, jobs, and even TV channels devoted to learning about the stock market. But today's stock market is much more complicated than it was when it first started. How do companies and investors use the market today? Let's say a new coffee company decides to start selling its products. First, the company will try to attract big investors by advertising. If they think the company is a good idea, they get the first chance to invest, and then they sponsor the company's first public offering or IPO. This puts the company on the official public market, where any company or person who thinks the business could be profitable could buy a stock. By buying stocks, investors become part owners of the company. Their investment helps the company grow, and as it becomes more successful, more buyers may see the company's potential and start buying stocks. As more people want to buy those stocks, their prices go up, making them more expensive for people who want to buy them and raising the value of the company's stocks that people already own. This increased interest helps the company fund new projects and raises its overall market value by showing how many people are willing to invest in their idea. But if a company seems less profitable for some reason, the opposite can also happen. If investors think the value of their stocks will go down, they'll sell them to make a profit before the company loses more value. As more stocks are sold and fewer people want to buy them, the price of each stock and the company's market value go down. This can mean big losses for investors, unless the company starts to look profitable again. Many things affect this back and forth between supply and demand. Companies can't get away from the effects of market forces, such as the changing cost of materials, changes in production technology, and changing labor costs. Investors may be worried about changes in leadership, bad news, or bigger things like new laws and trade policies. And, of course, a lot of investors are ready to sell valuable stocks and pursue their own interests. All of these factors create noise in the market every day, which can make companies look more or less successful. And in the stock market, a stock that seems to lose value often loses investors, which causes it to lose actual value. People's confidence in the market can cause both economic booms and financial crises. Because of this hard-to-track variable, most experts recommend investing for the long term over trying to make money quickly. But experts are always making new tools to increase their chances of success in this highly unpredictable system. But the stock market isn't just for people with a lot of money and power. With the rise of the internet, regular investors can buy stocks in many of the same ways that big investors do. And as more people learn about this complicated system, they too can trade stocks, support businesses they believe in, and reach their financial goals.